All right, welcome to the show. Thank you for joining us today for the next episode of Be the Bank, the very best resource on the internet for the secondary mortgage market. We throw in a little bit of bird watching as well. My name is Robert Haitha, your host, and it is my pleasure to introduce the newest member of the crew here. We've got a new wildlife, maybe not wildlife, domesticated life. This is our friend David Rose, the West White Highland Terrier. Or is it the White West Highland Terrier? He's just hanging out in his kennel for now. But we'll check in with him later in the show. Let's get right into it. But first, let's thank the 37 investors who signed up in the last 30 days since our last episode. So I'm not going to go through everybody's names here, but of the 37, 27 who have signed the non-disclosure agreement and are prepared for our February offering of mortgage note listings. So thank you so much to the 37 of you for signing up, and the 27 who took it the final step to get that NDA executed. Also, I want to thank the 26 mastermind members who've joined in the last 30 days. So we've got a really exciting mastermind group developing, and I want to show you a lot more of that later in the episode. But without further ado here, let's get into the show and start the episode. All right, so today we're going to start our episode number 29 with some free resources that we offer at FIXnotes.com. Then we're going to talk an overview of the industry. Of course, we're going to get into the tech that we use to make this business work. And of course, the mastermind membership. I really want to share with you the updates there and what we've got going on. And then finally, asset acquisition opportunities, case studies, of course, and then we'll talk about how to get on a free consultation call with me. Please let me know if there's any issues on your end. I'm seeing an error on my stream status on YouTube here, but everything else looks to be good. So leave a comment if there's any issues at all, and I will correct them. Okay, so let's get right into it with some free resources for note investors to start the call off. As you know, FIXnotes.com/learn is my How to Invest in Mortgage Notes course. It's got really everything you need to know to get into this business or to brush up on your skills if you're already a seasoned note investor. A whole bunch of great content there, all available for free over at FIXnotes.com/learn. So please check that out if you'd like to learn more about this business. We've organized all these different modules to really make it the best possible way, I believe, if you're into reading to learn. I personally advocate for doing to learn, actually submitting offers, reviewing assets for sale in your due diligence process, and that's what I feel is the best way to accelerate your learning curve. But this is an excellent place to start, and it's 100% free. We've also got FIXnotes.com/news. This is a news aggregator that I put together through an RSS feed. Captures all over the internet, all the industry content, and puts it all in one place for you. So definitely check that out if you'd like to get the up-to-date on the latest in the business. We've got FIXnotes.com/terms. This is a distressed debt glossary. If you come across any terms that you don't understand when you're communicating with sellers of mortgage notes or vendors, look it up in our glossary. That is also 100% free for you. The only thing that we charge for here is, well, other than selling notes, is the Mortgage Notes Mastermind. And I'm so excited to share this with you because we've added some new content. We now have 26 paying members. It's a really great group with a good mix of seasoned experts in the space and some newer investors just getting started. So that gives you access to a private Podio workspace with all of this content. We've got the events, the vendors that I've trusted in this space, a forum for additional discussions, case studies. Everything we review on the show every month is then added to the forum here. So there's a whole bunch more content in the Mastermind membership portal. We've got a database of all the counties and all the states in the country. Then we've got inventory records, which is a great template for you to organize your inventory database, as well as to review the actual underlying loan level data on the case studies that we run every week, or every month now. Then we've got document templates, which include letters and forms and other things to run your business. And then, of course, the newest addition, the aggregated trade desk, where we consolidate asset opportunities from around the marketplace to give our mastermind members access to other loan brokers and sellers in the space. So right now the price is $40 per month, but it is increasing to $80 per month incrementally. So we've got 5 more slots available at $40 per month. We already have 5 investors who are joined at $40 per month, 5 more available slots. Then the next 10 members at $50 per month, increasing the price by $10 for every 10 members. So definitely please join if you're interested. This price is going to permanently increase and you'll be grandfathered in for the lower rate. So this is a no-brainer right now. I've seen other masterminds in the real estate space that have been launched with $500 introduction fees and then $100 per month. So our value proposition here, I believe, is much stronger, and the network effect of our group is going to continue to add value here. So please consider joining the mastermind group. For the private Podio workspace, 50% off my consulting rates, and then monthly members only Zoom calls. We had our first members only Zoom call last week, last beginning of January, and it was an excellent call. We talked to one investor. We had 2 experts on the call, one speaking on contract for deeds, another mortgage note adjacent investment opportunity, and we also had another investor talk about using debt to finance mortgage note transactions. Both of those seasoned experts have hundreds of millions of unpaid principal balance under management, and it's really great to hear from the members in our group who have such skill and experience. So definitely consider doing that before the price increases permanently. All right, so let's get right into the industry overview here, and we'll start with our favorite slide, the due diligence waterfall. So this is a great place to begin our conversation with the industry overview, because your due diligence is the most important feature of your acquisition process. You make your money when you buy in real estate or many different asset classes, and mortgage notes are no exception. Your due diligence process needs to be tight so that you understand what type of assets you are acquiring. Now, our little friend over here is fussing a little bit. Oh, he's so cute, isn't he? So we might have to take him to the other room so he doesn't interrupt my train of thought here. But before we let him go, just say hello one more time. What a little cutie. I'm going to let him go until he starts barking, which he's just learned how to bark in the last couple days. So he maybe will exercise those bark muscles soon. But we'll leave him there for now. All right, so the non-performing waterfall evaluation starts with secured versus unsecured. Now, this is the top of the chart here and the most important driver of price. If a loan is secured, it means you can foreclose and you have underlying collateral protecting your lien. If it's unsecured, that means that collateral does not exist anymore and there is no remedy of foreclosure to enforce your mortgage note. And what we're going to do today, we're going to drill in. This is the first Be the Bank episode of 2021. We're going to start at the top here. And we are going to review, if I can get to it here, somewhere, secured versus unsecured. All right, so secured means the property owner equals the borrower in the most broad sense. Now, we'll explain that in a little bit more detail here. A lien becomes unsecured when there's either a senior lien foreclosure, when you purchase a junior mortgage that gets wiped out by a first position foreclosure, or a tax deed or a sheriff sale. So a tax deed sale is essentially what would unsecure you if you were in first position. Essentially what's happening is your lien is being subject to a priority liens foreclosure event, either a senior lien foreclosure or a tax sale or a tax sheriff sale. Once a lien is unsecured, like I said, you no longer have the remedy of foreclosure, but you still have the personal liability of the note. You can still collect on unsecured loans because the borrower has signed a promissory note that is still due and payable. However, there are some ways that the promissory note can lose the personal liability. One way is the statute of limitations. The statute of limitations essentially is a timeline of enforceability. Once you reach a certain criteria, the loan is no longer collectible through the personal liability of the note. Now that can be based on the maturity date in some states. For example, Florida has a 5-year statute of limitations clause where 5 years beyond the maturity date, the loan is no longer collectible. We've actually run into that problem in Florida on secured liens, and the courts ruled that the secured lien was no longer collectible because it was 5 years beyond the maturity date. Something to keep in mind. But generally, the statute of limitations is triggered by the last payment date or the next due date on the loan, which Once you reach that expiration, which is 5, 7, or 10 years in most states, then you no longer have that personal liability to collect upon. Now, you can also remove the personal liability from a loan through a discharge bankruptcy. A discharge bankruptcy will essentially not allow a debt collector to collect on liens that have been stripped in the bankruptcy, are now unsecured, and then have no longer any personal liability because the bankruptcy has been completed and discharged. So there's a couple ways that you can determine property ownership right off the bat to see if the borrower matches the owner of the property on title. The first bet is to go to protitleiusa.com/order. Now this is a really great resource because it lets you, before you order an actual title report, it lets you get the summary data. It lets you see who the expected property owner is. And from speaking with the CEO over at Pro Title USA, we know that that's about 80% accurate. And it's a pretty great place to start because it's free. It only takes your time or your assistant's time if you have somebody working on data entry, and you can quickly determine who owns every property in your portfolio. Another way you can do that for free as well, if you have a DataTree account, is to use the DataTree dashboard. And the DataTree dashboard is great because it's the launching point to order title view reports and other types of documents that DataTree offers. But when you're just searching the file, it's free to begin with. So you can search for free, see who the property owner is using DataTree. Now there's an asterisk next to both of those because they're not in real time. If you want to go right to the source, it's the county property records that are going to tell you who the current owner is with the least amount of delay. Pro Title and DataTree are going to be aggregating their data through other sources that sometimes have somewhat of a delay of about 30 days. So to go right to the county property records, you can eliminate that delay, get the most up-to-date information on who owns the property. You can also do a lot of other things on the county property records. If you go over to the tax assessor's portal in that specific county, you can see the borrower's mailing address. So you can not only see if the borrower still owns the property, but you can see if the borrower resides in the subject property, whether or not it's owner occupied. So get comfortable with the county property records. Or use these other two as shortcuts, Pro Title USA or DataTree's dashboard. So there are a couple of instances of false positives and false negatives when you are doing this rudimentary property owner matching the borrower search. One would be if the property owner matches the borrower, but there's been a lien release that's recorded in the county records. That would be an unsecured loan. Even though it looks secured because the borrower still owns the subject collateral, the lien that is actually securing to that property being released means it's no longer secured. Now, I have seen lien releases that remove the secured interest, they remove the lien, but they retain the personal liability. So that's something to look for if you see a lien release and you are open to acquiring unsecured loans. See if the lien release specifies the personal liability of the note still being due and payable. Now, you can have the opposite effect if it doesn't look secured, the borrower name doesn't match the property owner name, but you find a quitclaim deed, a QCD, is subject to existing liens. So essentially the borrower could transfer the property, but the new owner of the property could still owe the borrower's mortgage. Now this would trigger a due on sale clause, which means that the loan would be due and payable in full if the loan was transferred without notifying the lender. But in any case, when you're buying non-performing loans, for the most part, those loans are due in full because of the default. So those situations, the loan could look unsecured, but is actually secured because the quitclaim deed is subject to the lien, the subject asset that you're looking at purchasing, the mortgage note. And then, of course, this little asterisk for Dashboard and Pro Title USA being delayed. And that's an important thing to consider. And I would recommend looking at the county property records for the most accurate information. So that's the non-performing waterfall evaluation. And what I use to structure my due diligence process from when you first get a mortgage note tape, a portfolio, which is normally in Excel of all the data, and then you append your own data through your research process. Now we'll get into more of these different tiers along the waterfall in our next episode in February. But if you want to look back at our previous episodes, we've covered a lot, if not all, of these different categories in much detail over the last year when we were running our weekly episodes in 2020. So in the meantime, check those out and then prepare for our next episode. Feel free to leave a comment below this video once it's published to request any specific information or highlight any of these to qualify for you to make you a little more comfortable with your due diligence process. All right, so let's move on from the waterfall evaluation and get into the market pricing for the first quarter of 2021. So we've had a little bit of some developments here that I wanted to share with you so you could see exactly what we're talking about going into our February offering when we put out some new mortgage notes for sale. So on the left side, we have reperforming loans. On the right side, we have non-performing loans. And then you see on the other axis, we have senior position or junior position. So this is a pricing, very rough pricing matrix to explain the differences in pricing between cash flowing and defaulted mortgage notes. So we'll start off on the reperforming side. And you'll see that both the senior lien and junior lien reperforming loans have decreased in yield. -5 basis points for senior, -10 basis points for junior. And now what it looks like at a first glance is that maybe the price has decreased, but when yield decreases, the price increases. So what you can expect to pay for performing or reperforming first position liens in today's market is around 7.5 to 12.5% yields. So this is your cash on cash return. You would essentially earn the upper end of 12.5% on your invested capital per year buying reperforming first position loans. On the reperforming junior lien side, we see stronger yields. In second position, the investors, the market is commanding higher returns because junior liens are inherently more risky. But as you know from my show, I prefer junior liens because you can mitigate most, if not all, of that risk through proper due diligence. But in junior liens, we're seeing yields around 11.1% up to 20.3%. So you'd expect to break even in about 5 years at the upper end for junior liens, 20% return on your capital per year. And that's typically what we're seeing in the reperforming market. Now, these yields are actually even lower if you're buying performing loans. Performing loans essentially are paying as agreed and have never went into default. Reperforming loans, I believe, are just as safe if they've been modified properly, have stronger yields because the borrower did go into default at one point in their legacy of borrowing that money. On the non-performing side, we'll pivot over to the pricing based on fair market value for senior lien and the pricing based on unpaid principal balance for junior liens. So in this side, when we see the price increasing, that is actually effectively a price increase because we're seeing stronger values as a percentage of the unpaid principal balance in junior liens. Now, we price senior liens based on fair market value because more often than not, senior liens resolve through the collateral, through the property. So it's very important to understand the underlying collateral value. And we're seeing pricing around 7% to upwards of 80% plus on the percentage of the fair market value. Now, when you're analyzing first position loans to purchase, you need to be very, very cognizant of the unpaid principal balance because if you are pricing based on fair market value in a vacuum and you're not looking at the unpaid principal balance, you could actually pay more than par. Par value is the UPB, the principal balance. You'd be paying more than the UPB if there's actually equity in that account, if the fair market value is more than the unpaid principal balance. However, for the most part, we see the upper end of this range when we're looking at higher value properties. So essentially the lower band, the lower value homes typically are deteriorating faster. They have less borrower emotional equity, and sometimes there's more of a possibility of strategic defaults in the lower value properties. Whereas with higher value homes, $100,000 or more property values, we see more pride of ownership. The borrowers are taking care of those properties better. And as a result, we see higher percentages of the fair market value in the resulting pricing. And then on the junior lien side, we price based on the unpaid principal balance because second position loans more often than not resolve through the borrower. And sometimes even if there's no equity in the property, the borrower has some amount of emotional equity that do allow them to continue to meet their obligation even if the numbers on paper don't exactly make sense. So in this case, we see pricing around 5% all the way up to 62% of unpaid principal balance, with the biggest driver of that being the senior lien status and the equity that's available to the junior lien. So You guys know, if you've been watching the show, that senior lien status for junior liens is the most important thing, and looking at credit reports when you're buying junior liens is the most important bit of due diligence you can do. And of course, in future episodes, we'll drill into that in much more detail. All right, so let's pop over to one more industry update section, and that is speaking on regulation and the Consumer Finance Protection Bureau. So with the new administration going into 2021, we do expect to see more regulation and more enforcement of said regulation. So it's a very important thing to be totally up to speed on the CFPB's code, their laws, so you understand how to operate in this business along the letter of the law. So one update to share with you this week is the nomination of Rohit Chopra to lead the agency. Now, this nomination is expected, but it hasn't been finalized to the best of my knowledge. But from what we see, Rohit Chopra will be, oh, here comes a heron. Let's take a quick, oh no. Let's do the, oh, we missed it. And my, my contrast, my exposure was all out of whack there. A heron just flew down across my window and I couldn't show you. Sorry, guys. So in any case, Rohit Chopra, from his track record, is going to be very much enforcement. And it's very important that his nomination is going to affect the enforcement of this regulation. This is good for borrowers, especially student loans. Rohit Chopra is particularly known for that side of the business, student lending. So that's going to be a good thing for student borrowers and potentially onerous for lenders. But at the end of the day, mortgage debt is a little different than student loans, and having an underlying collateral in mortgage debt, I believe, bodes well for lenders in this side of the business. Student loans are a whole nother thing, and the fact that there's no underlying collateral in student loans and they can't be discharged in bankruptcy. I mean, there's definitely some important changes that are probably going to happen in student loans as we move through this next administration. All right, so let's get right into the show here. Let me see if my bird cam, okay, I fixed the exposure. That's good. Let's zoom out a little bit. And we've got the telephoto lens on this camera, but no birds today, no birds. I do want to show you, though, before we get into the primary content on this episode, a little footage I took the other. Okay, let's jump into Stoic philosophy for modern entrepreneurs. So this is, and I could do it this way maybe, still blocking the screen. I am by no means an expert in Stoicism, but I've been listening to an audiobook and doing some research, and I thought it was useful as a philosophy for modern entrepreneurs and especially note investors. I think in general, the times that we live in, if you know how to play the game, and if you're watching this video, you're definitely along the right path to your own personal financial freedom, life can become a lot easier than it was back in ancient Greece. And the need to have some philosophy to prepare to weather the storms that may or may not come in your life is all the more important, because we get soft when we've got passive income and we've got our lives set up in a way that there isn't worry in that aspect of our life. Things can still happen, bad things can still happen, and having an idea of these Stoic philosophies can very much benefit your own psyche in the event that things happen that aren't what you expect or what you want in your life. So this is a bust of Marcus Aurelius. Marcus Aurelius was one of history's few philosopher kings. He was a Roman emperor and he didn't found the Stoic philosophy, but he built upon the Stoic philosophies of Epictetus, Seneca, and their forerunner, Zeno. So we're going to talk about a couple of idioms, a couple of different philosophies that they had that I believe are very beneficial to modern day entrepreneurs. And we'll also fast forward in history a little bit to get some insights that have been developed in more modern thinking based on these philosophies. So essentially, Stoics practice emotional and mental discipline to free themselves from the hedonic treadmill. So the hedonic treadmill was a more recently coined term, which essentially means that humans very quickly revert to the mean. If you buy a bigger house and you get a nice car and your life is better for a short time, but then you become accustomed to it. And then you're back on the treadmill trying to want more. So Stoic philosophy essentially frees you from that hedonic treadmill to find happiness outside of material wants and pleasures. So I think it's very important to balance the capitalist side of this business and entrepreneurship in general with this more grounded Stoic philosophy. So you can focus on the more important things in life and making a difference. So I'm going to pull myself off of the screen here. So this was Zeno of Citium. He was pretty much the first founder of the Stoic philosophy. And his prescription of how to live a good life was to follow logos, universal reason. So the path to a good life is living in accordance with reason. And that's the purpose of a human life and a worthwhile existence. And it's the opposite of living in accordance with instinct of impulse and passion. Because that type of pursuit, when you're just kind of following the whims of your own wants and needs, is really of no more significance than an animal, like this little guy. He's always just fussing and wants attention, and he's not thinking about the greater good because he's not a human. And we have the capacity to that, so it is then our duty to make the world a better place in accordance with logos. So the Stoic philosophy had three, at least in Zeno's writings, had three essential pillars of what was important, what was good, and what was to be focused on. Science and nature was a big one. Physics, I think, is what they call it, but it really encapsulated all of science and nature. It's to seek to understand your existence and the world around you, to study how things work, to be curious, to strive to understand things is very important so that you can know how to make a difference. Logic and rationale was the second one. So applying your mind to solve problems, striving to improve your thinking and your communication skills, getting better every day in your own cognitive abilities was the second pillar. And the third pillar are ethics and morality and living with meaning to be capable of making the world a better place. So these three pillars essentially are what the framework we use thinking through the Stoic philosophy to make the world a better place. Because to decide how best to live, to decide how best to live through ethics, one has to understand how the world works with science and then reason appropriately about it through logic. So the Stoic virtues then that resulted out of these three pillars are prudence and practical wisdom, justice and morality, temperance, moderation, and then fortitude and courage. And by combining these timeless virtues, you can live a good life according to the Stoic philosophers. So let's look at a quote from the one and only Marcus Aurelius from his book Meditations. And I've not read this whole book, so I'm, like I said, not an expert on Stoic philosophy, but I definitely can see the benefits of understanding this type of thinking. So here's the quote: "If you seek tranquility, do less. Do what's essential, what the logos of a social being requires. Do less, better. Most of what we say and do is not essential. If you eliminate it, you'll have more time and more tranquility. Ask yourself at every moment, is this necessary?" It's kind of like the 80-20 rule, where 80% of your results come from 20% of your efforts. And that's the Pareto principle. If you can identify the things that are most important in your life and focus on those things, that's how you're going to have the greatest impact. And it's funny because this quote was a little more verbose and I clipped a lot of it and put the ellipses. So I actually took his advice and eliminated what was not essential in the quote to bring you the distillation of that, the most important concept in my thinking. All right, so here's another thinker. This was Epictetus. He came before Marcus Aurelius, and this was from his writings in Discourses. "The chief task in life is simply this, to identify and separate matters so that I can clearly say to myself which are external and not under my control, and which have to do with the choices I actually control." So this is a major concept in Stoic philosophy, and it's called the dichotomy of control. And the dichotomy of control is really the only way to find happiness by ceasing your worrying about things which are beyond your power and focusing on the things that are within your power that you can improve and not waste your mental bandwidth on things that are just totally outside of your control. So very, very important principle that the Stoics lived by. And this is one of the other Stoic forerunners. Seneca the Younger was born in 4 BC, just about circa 4 BC to 65 AD. And this is a really simple quote: bring the mind to bear upon your problems. And I think in full context of his writing, this would make more sense, because you're bearing your mind on the problems, the things you have control over, and not dwelling on the things that are totally out of your control. I think that in today's world, especially with what you see in the stock market and how you can feel like you're missing out, and you can be chasing things that are totally outside of your control without focusing on what is in your control to make your life better progressively on a day-to-day basis. So this is something that I've been thinking about, especially when I look at, like I was trying to mine Bitcoins when they were worth 50 cents a piece. I bought and sold Tesla 9 years ago. Like, there's all these different areas where I can, if I think about it too much, I dwell on it, and it's totally outside of my control that I miss those opportunities, or I didn't take full advantage of what could have been. But that does me no good to dwell on these things that are totally outside of my control. And that's a big reason why I like alternative investments like real estate and mortgage notes, as opposed to traditional investments like the stock market, because these alternative investments are in my control to add value, and they aren't based on speculation. They aren't based on things that are going to just become emotional if I make the wrong decision. Whereas when I'm making my own decisions in my own business to improve value, to add value to the assets that I own, those decisions are within my control and the best use of my time, in my opinion at least. So here's a quote, another idiom, very important in the Stoic philosophy, and it's just the simple words, memento mori, which just means to remember your mortality, to accept the good things without arrogance and the bad things with indifference. So let's hear another quote from Epictetus. What shall we do then? Make the best use of what is in our power and treat the rest in accordance with its nature. You treat it with equanimity, another really important Stoic word, to be level-headed and even with your emotions, with things that are outside of your control, and really focus your efforts on the things that are within your power. Here's a more contemporary version of memento mori and seeing what's in your control and what's not. It's Reinhold Niebuhr's prayer, the Serenity Prayer. God, grant me the serenity to accept the things I cannot change, the courage to change the things that I can, and the wisdom to know the difference. That's a very great encapsulation of the dichotomy of control. And he was heavily influenced by Stoic philosophy in developing this prayer. And I think it is an important prayer, an important meditation that you can take if you're a part of any religion, because it's essentially giving you a better concept of this dichotomy of control so that you can focus on the things that are possible for you to control and to make a difference, to make things better. The end result of all of this is reaching a state of ataraxia, the state of freedom from emotional disturbance, tranquility, serene calmness, imperturbability, and equanimity. So equanimity, like I said, is mental calmness and composure, especially in the face of real issues in your life. The things that maybe would set you down a bad path if you didn't think in terms of this dichotomy of control are then resolved through this feelings of ataraxia. So that's it for our show highlight here, the Stoic philosophy for note investors. The Stoic philosophy is for modern entrepreneurs. So let's get right into our back to mortgage note content, the tech tips for today's episode. So I'm excited to share the tech tips today because we're actually going to use them to drill down into the mastermind group, so you guys can see exactly what's going on over there in the mastermind and if it maybe is a good fit for you and your business. So we use a whole bunch of different services as part of this business for efficiency and automation. Podio for our database CRM, Pacer for bankruptcy, Right Signature for document executions, Zapier to connect APIs across the internet, CoreLogic for bulk due diligence, DataTree for one-off portfolio due diligence, Zillow for recently sold comps and other property data, Google Sheets and Excel, really the engine behind our modeling and what we do to price out assets. Pro Title USA and TransUnion TLO XP are some of the other due diligence providers. Now we have so much more content behind the scenes in the Mastermind member portal, which give you a lot more context as to what types of reports these providers share as the results of the due diligence and other information that could definitely help you out here. So we're going to zoom in on Podio today, and we're going to just pop right on over, if it works, to our Podio workspace. So this is the Mastermind workspace behind the scenes. You'll see, I can't even see my mouse on this screen. This might be an issue, guys. Let me switch something up here. We'll mirror this screen. No? Okay. Really screwing up here, guys. One more try. If we mirror this. Okay, there we go. So this is the Podio workspace. This is what you're able to access when you become a member of the Mastermind group. We've got 28 members. 2 of them are me and my assistant. So we've got 26 paid members in this group. And this is the activity stream. So this page is where all of the content throughout the Mastermind group gets aggregated, so you can get a snapshot if you come in and you want to see what's happened in the past forever. You can actually go all through time in this page. We've got a snapshot of the Mastermind calendar, and welcome to the workspace. So first thing is the events column. This app captures all of the events that I'm seeing in the marketplace, the webinars, the YouTube episodes that I host, and other industry events. So you can click through and see a lot more content on each of these events. You can get links and the cost and other information that's very important, so you can determine if this specific event may be good for your business. Then we've got vendors. This is a new app that we just started to develop, and this is the due diligence vendors, service providers, and other counterparties that I have found are good to work with. And what you can do here, which is really cool, if you look into a specific one of these vendors, you can see what their data reports look like. So here's an example of the output from Credco. Let me slide over here. An example of the output from Credco, an example of a credit report from Credco, and super important so you can see when you actually use these vendors what the result is, what you're actually getting for your due diligence expense. Other vendors here like servicers and IRA providers and document custodians, a whole bunch of great content here. And this can also, as we develop it, users can comment and our members can kind of share what experiences they've had with these different vendors. Next, we have the forum where you can ask questions, start conversations, participate in the latest discussions. Really great, and it's growing very well here. We've got a lot of organic traction here from the users asking questions and sharing the knowledge that they've learned in the business with attachments. Like here's a price approximation spreadsheet that one of the members is working on. So the forums is a really great place to have conversations with me at no additional cost. You're essentially working with me as a consultant, but as part of the mastermind. Then we've got case studies. These are all the case studies, including the 2 that we're going to present on today's episode in much more detail. And so you'll see that each episode has 2 case studies, and then when you click through to these, and we'll add the timestamp link for this episode's case study, you'll see what type of exit, the lien position, the status, the property type, and then if you click through to here, you'll get all of the inventory records and like all of the data behind the scenes of this loan. So we'll look at that in a minute. Then we've got counties. Just so this doesn't take too long to load, I've popped it up here. There's 3,000 plus counties in the country, and we've aggregated information on as many of them as we can, and this is constantly being added to. Whether or not you can log in and see deeds online, and then you'll have a link on where to actually do that. A whole bunch of more little snapshots, property tax, the phone number for the tax collector, whether or not it's a judicial, non-judicial, well actually that's in the state side, but a whole bunch of content there on every single county in the country. And they're organized by zip code, by the way. You'll see down here. So if you just search a zip code in the mastermind group, you'll get a link popped up right away of the county that that zip code is associated with. Then on the state side, every county is linked to the relevant state. These are the laws, the estimates on foreclosures and REO expenses. Let me pull myself off here. foreclosure timelines, foreclosure redemption amount if you're paying off back taxes, deficiency judgment state or not, months to sale, months to REO sale, foreclosure costs, links to the state details, judicial, non-judicial, tax lien or tax deed, deed of trust or mortgage state, tax redemption. Like, there's so much content here, which is super useful, and it's a really great place to consolidate other discussions about state-by-state regulations. And as we develop the mastermind, users will add some more content here that will be useful to the future of this group. And that's why the price is going up, and that's why the price started lower, is because as this group develops, it's already seeing leaps and bounds more value than it was when we launched it at 30 bucks a month. We've already got 5 members at 40 bucks a month, 5 more slots available at 40, and then the price continues to go up. So definitely, if you think this will be beneficial to you, which I know it will be if you're in this business, consider joining. Next, we've got inventory, which I also pulled up because it's a very big app. There's over 4,000 records of completed case studies, future case studies, all types of exits, reperforming loan sales, non-performing loan sales, resolutions, short sales, deed in lieu, REO sales, all sorts of different content here, even loans that have been wiped out. So this is a really useful way to see actual market intelligence. So you can use this app, you can use these filters to just see, let's see, we only want to see non-performing loan sales, and we only want to see loans with a particular percentage of equity, with owner-occupied collateral. You can essentially drill down and see specific pricing on specific types of exits, and you can use this to data mine to build your own model. Next, we've got document templates. Like I said, this has forms and letters and other things that you can use, calculators for amortization, options, letters, purchase sale agreements, all sorts of content that we're going to continue to add to as necessary. And then finally, one of the other latest additions to this workspace is the aggregated trade desk. And this is really cool because we've already got 38 separate opportunities here, totaling $622 million of unpaid principal balance from various different sellers and brokers around the industry. So this is going to continue to be developed over time, and as a mastermind member, you have access to all of this content. All right, so let's jump back over to our presentation here, like so. And I got to turn that music down, I think. Okay. So let's move on to asset acquisition opportunities. That was just a quick overview of how I'm utilizing Podio for the Mastermind membership group and all of the various content that's being constantly added there and developed by myself, by my assistant, by the other members, and then hopefully I'll have like a community manager position also, so that we've got another full-time member just adding value constantly to that Mastermind membership group. So join it before the price goes up. In the meantime, let's talk about a non-performing second mortgage secured by a condo that was resolved with a discounted payoff of $9,400. So this specific account was secured by a condo worth $108,753 with a senior lien value of $57,731. So right off the bat, there's $50,000 of equity securing $13,432 of unpaid principal balance. So you might be wondering right off the bat why this was settled with a discounted payoff agreement, because of the amount of leverage we had here. Full equity coverage and then some secured this specific second position mortgage note, but yet we actually offered the borrower a discount. So let's actually see what happened so you'll understand why. Then we'll talk about where is the borrower now and what do they want to do. These are the 3 questions that we ask borrowers in the beginning of a resolution process. What happened? Where are you now? And what do you want to do? This frames our resolution efforts to create a win-win with the borrower. So what happened in this case? The borrower was diagnosed with multiple sclerosis. They also were fraudulently targeted with this Ponzi scheme and ended up drawing the full balance from their home equity line of credit and deployed it into this Ponzi scheme, which they lost all of the proceeds. So that was a pretty unfortunate start to this borrower's history with this loan. And we found that information out through the borrower's hardship letter, by the way. So where are you now? So they are living in the subject property still, and they've got an inheritance, but this inheritance has been exhausted. They did use those funds to pay off some other bills, but they're still behind on this non-performing second mortgage. Good news is their brother is helping put the finances in order. So that was probably the biggest help here. Is they've had another family member helping them out, not only with the conversations and being a third party authorized representative of the borrower, but also with some of the capital. And I believe the borrower's proceeds helped pay off this discounted payoff. So before the loan was purchased by my client, the bank had actually offered a settlement of $6,800 just a few months prior to the loan sale. And the borrowers unfortunately failed to take advantage of that offer. So when we ended up having this conversation, that was no longer on the table, but the borrower still kind of had it in their mind that that was what the loan was worth, or that was what they could get the loan discounted payoff for. But as you'll see, that was no longer the case since that option was expired. So we ended up negotiating a $9,400 discounted payoff to close by the end of the month in that specific, I think it was November of last year when we finished this deal up. So this was a higher payoff amount than what they thought was offered previously by the bank. But since that offer was no longer valid, it was really held no bearing on the negotiation efforts for this specific discounted payoff. And it's about 70% of the unpaid principal balance. So even though it was possible to enforce this debt more fully, we could have tried for a full payoff or threatened for foreclosure or went in a different direction to be a little bit more aggressive. At the end of the day, a 70% discounted payoff on a loan with some underlying issues as far as the borrower's situation and their affordability, looking at their financials, $9,400 was the best we could do, and that's what we ended up accepting on this file. So with the loan being at a non-performing loan value of $5,650, around 42% of the unpaid principal balance, a $9,400 discounted payoff in a short amount of time was actually a very substantial return. So over 4 months, $440 of expenses, which took us through the due diligence, the onboarding, and the collection process, we resulted in that payoff of $9,400, which I've screwed up my animations here. Sorry, guys. 70% of the unpaid principal balance, which resulted in a 199% internal rate of return. So let's get all of our content back on the screen here. Yep. Okay. Hopefully it didn't go too far. No, I went too far. All right, let's just talk about the takeaways. So this was a low combined loan to value. So there was equity in this property. The CLTV was less than 100%. But since it was a condo collateral, not a single family residential property, there was somewhat of a discount to the non-performing loan purchase as opposed to a single family property. Condos generally command more of a premium, or more of a discount, because of the fact that there's typically HOA fees, and generally the values are a little lighter than you'd see from single family properties. This was a discounted payoff offer from the bank originally that was no longer valid. It was expired. So this does not affect our current negotiations. That's really important that you don't let the borrower try to change the narrative around some previously offered settlement. That's no longer available. The full balance is due and payable. So that's the basis of your negotiations. And then finally, this was an equity non-performing loan that was sold as a one-off for, this is what I'm trying to explain. As a non-performing loan, this would be worth about 60% or less of the unpaid principal balance. As a discounted payoff, we achieved a 70% discounted payoff. So this gave us, the investor, more income, more of a payoff, more proceeds than they'd receive for selling the loan, and also passed that discount along to the borrower as well. So we increased the investor returns by doing it very quickly, and the borrower got a stronger savings because it was worth less on the open market. So that 199% internal rate of return was a result of a 4-month turnaround. So that's really what affected the rate of return so strongly. The fact that it was a quick payoff. So we could have forced the foreclosure, we could have tried to negotiate a little more aggressively, but every single month that terminal value extends, every single month that it takes to get to a full exit proceeds, are going to decrease your internal rate of return. So you could actually have been looking at a lower rate of return even though you got a full payoff if that full payoff took 2 years or more instead of the 4 months that it took. So Important to consider here time versus money and how you can benefit all parties by accepting more of a discount but doing it earlier in the process. And that's why we really offer a lot of incentive to borrowers who are proactive in calling us and work out their payment arrangements or discounted settlements earlier in the process because of that time value of money. So I apologize about the screwed up animations here. That was my mistake. Let's jump over to the next case study here. And this one is a loan sale, and particularly a reperforming second position loan. So this is also secured, well, this was secured by a single family residential property instead of a condo. So it's definitely stronger value than that last deal that was secured by a condo right off the bat. More so because it is cash flowing, not non-performing. And this loan was sold for $43,598. So that $43,598 purchase got them a $272,000 property as collateral behind a $133,979 senior lien, which leaves $138,021 of equity protecting a balance of $68,965. So this was a cash flowing loan though, so is priced based on the return and based on the yield that the investor generated by acquiring this loan. Three things that we cover on sales, bulk or retail sale, due diligence findings, and the final purchase decision. So this was a bulk sale. This was part of the year-end closeout of 2020 legacy inventory. So pricing was a bit more attractive than it would have been as a retail one-off sale, but still, as you'll see here, a pretty good return for the investor who purchased it, as well as for the loan seller, my client. So the due diligence findings on this one are the senior lien was current. So the first position mortgage is paying their obligation every month. The subject property is owner occupied, which is very positive. The modification was completed on this loan at $485 per month, a 7.5% interest rate, and there's been 10 months of seasoning. So this borrower has been paying their $485 payment for 10 months consistently, month in, month out. They're making their payments per the modification agreement that we put in place. So the pricing decision on this loan, you'll see, really values the equity in this property and the internal rate of return more than the cash on cash yield. So you'll see the cash on cash yield is kind of low on this, but the fact is the sooner the loan pays off because of the strong balance and the equity in the deal, the stronger the return will be because of the time value of money for the investor. So the final purchase decision on this loan was to buy the loan for $43,598 as part of a package of reperforming loans. And some other considerations here, the internal rate of return is substantially higher with an early payoff due to the discount. They're getting a pretty significant discount to the principal balance on this loan, but because the monthly payment is relatively low, that's kind of the weakest link here, which we'll see in a minute. Now, it was a stronger buyer discount due to the bulk acquisition. And then this point I think is very important to understand when you start modifying loans. The reperforming loan value is going to be contingent on a couple different factors, but in this case, the weakest link is a relatively low monthly payment. And this is the limiting factor for the investor who purchased the loan. If the payment amount was a little bit more, they could have paid substantially more for this loan because of the significant equity and because of the balance being pretty attractive here. So in reality, I think a good rule of thumb, if the borrower can afford it, is around a 1% payment of the full principal balance. So we could have been looking more at like $690 per month payment. That would have achieved probably the best possible return on this loan. So we were a bit underselling it based on the lower monthly payment. But that was what the borrower could afford, and they've been consistent with it. So at the end of the day, this deal still worked out really well. So this $43,598 payment is 63% of the unpaid principal balance. Now, that's a very good price for a mortgage note that's got this amount of equity and is paying and everything. But because of the fact that the borrower has a fixed rate modification agreement and they don't have to pay it off early, if you held the loan for the full life cycle, you really are only returning 12.6% per year on your money. But because that borrower has equity, because there isn't really any risk of getting the full payoff at some point, the sooner the loan pays off, the higher the internal rate of return is going to be. So that's really why the investor purchased this loan at the price they did, because they've got this potential of an early payoff. They've got a pretty low cash on cash return, but they're well protected here. All right, so that's it for the case studies. We covered a loan sale, we covered a resolution, and now we're going to talk about how you can get on a free consultation call with me. So I offer 15-minute consultations to investors who are meeting me for the first time and want to know how I could help them, and really this first 15-minute consultation can be totally actionable. It doesn't have to just be an introduction. You can ask me really specific questions and we can work on your specific issues on your portfolio or in your business. So I'd highly recommend, if you're interested, to get on a free consultation call with me. It would benefit me and the channel greatly if you subscribe to the channel and like and comment on this video. And that's kind of a prerequisite, but I'm not going to enforce it. So if you want to get on a consultation call, all you got to do is go over to robbymax.youcanbook.me and pick a time on my calendar. We'll get on a 15-minute call. So let's wrap up today's episode with the upcoming schedule for the rest of the month and for February. So we've got our mastermind call coming up in the first Wednesday of every month, and that'll be on February 3rd. So mastermind members, get ready for that. I already have 2 speakers lined up, 2 other mastermind members who have combined thousands of notes under their belt, along with rental properties. So we're going to be talking about rentals versus mortgage notes, how to diversify between them, how to manage a team across different verticals in your business. And we're also going to be discussing, what's our other call? We might be discussing tax liability for note investors as well. If we can get a professional that understands that. We don't want to just be taking an investor's word. We want to talk to a CPA there. So we might postpone that. Last mastermind call at the first Wednesday of January, we had a really great conversation around contract for deeds and around raising capital through debt instead of investors. And that was great. I think almost every mastermind member turned up. We had like 25 people on the call. And that call is recorded and available to future mastermind members. So like I said, the value proposition of the mastermind group continues to increase. There's always new content being added and the price will go up. So please consider while you can, for your own sake, joining while the price is lower. So if you want to do so, head on over to FIXnotes.com/MNM for Mortgage Note Mastermind. And then if you're already a member, over at podio.com/FIXnotes/mastermind, you can get access. So thank you so much for considering the mastermind. That's the best way you can support the channel, as well as support your own business in this mortgage note space. So I'd highly recommend you consider that. All right, so that is it for today's episode. Let's take a quick look at the feeders. No birds today. And our friend, he's gonna be the star of the show. There's our little white West Highland Terrier named David Rose. And to wrap up the show here, we'll let him out of his kennel and see what he wants to say to the camera. But in any case, thank you for tuning in to Be the Bank, where we cover the mortgage note industry in extreme detail, and we're always looking for suggestions. If you leave a comment below, we will go into much more detail. I'm not going to hold anything back for you guys. But as you know, the mastermind group has the best, most up-to-date content, and that's really where I've dedicated most of my time over these last 30 days. So it's going to continue to improve and get better. Definitely consider that. All right, let's check out, let's see what he wants to do. I'm going to pull him out here, and until next week, or till next month, end of February, last Wednesday of the month, I'll be back on YouTube. And if you want to catch me before that, book a consultation call or consider joining the mastermind. Thank you so much, everyone. I'm going to take off my mic, and we're going to say hi to the little goober before we call it a day. Thanks, guys. Have a good one, everybody. You want to get out? Yeah, come on. Let's do it. Yeah. There you go. Nice. Oh, give it a good stretch. Don't eat the carpet though, friend. Say hello. Come here, guy. So you'll see him next month, and he'll probably be a little bit bigger then. So this is great to document the little guy's upbringing as our new mascot. such a sweetheart. All right, thanks everybody. Have a great day. See ya. Oh no! He had an accident. Why? Because I took him out and tried to play with him.